back to this week's market update. Today is Friday, August 11th, 2023. We had an eventful week, so let's jump right into it. Even though we are a bit far from the next FOMC meeting in this Fed-centric economy, all eyes were on the inflation prints, as well as the unexpected credit downgrades of 10 small and mid-sized banks this week, as equity saw large intraday swings. As of close on Thursday, August 10th, the Nasdaq Composite was down 1.8%, the S&P was down 1.1%, and the Dow Jones Industrial Average was down 0.8% for the week. Jumping right into our news of the week, the biggest shock to markets was the bank downgrades of credit ratings on certain banks in the mid and small size categories by credit rating agency Moody's. So you can see here are the 10 banks that were downgraded, still have great credit ratings overall, but were downgraded quite a little bit. So you can see those and the variety of outlooks that they have between stable and negative. You can also see here the banks under review. So you can see Bank of New York Mellon, quite big, US Bancorp, State Street, etc., quite big and significant mid-sized banks. Here you can see also the banks that were rated to having a negative outlook, including PNC, Capital One, Citizens Financial, so quite big banks that now have a negative outlook. So Moody's main reasoning for the actions largely revolved around higher funding costs, as well as limited loan growth and possibly a commercial real estate underperformance in that segment, and also interest rate risk as well, as the Fed continues to probably hike rates, maybe even one more time. At this point, the team is viewing the impacts of these recent downgrades as simply just short-term catalysts in markets. However, we will continue to monitor the situation closely, and I will show you one other slide related to this next. Another chart here that goes into a little bit more deep reasoning behind the downgrade and the review and changing of the outlook for so many banks. Here you can see the median deposit cost and loan yield versus the Fed funds rate over the last 8 years or so. So here you can see the median deposit cost to banks is about 1.5%. This has grown so much, as the median just a year ago was 0.07%. And so this is kind of like what they pay their depositors to hold on to those deposits so that they are able to loan those to other people and grow their net interest income. So you can see here that has increased from essentially 0 to 150 bips in the matter of 1 year. So a huge move there. While other data points here, like the Fed funds rate, that's also taken a huge jump as well. However, the median loan yield here has ticked up quite a bit, but 1 year ago it was still at 3.64. It has not even doubled quite yet. So the rates and the interest that banks are taking in on loans is not so much evening out with the interest that they're going to have to pay depositors. So this is really what is putting a lot of pressure on the banks that are in these reviews. So just to go in a little bit deeper of the reasoning, but yeah, we're not super concerned with these downgrades, just something to keep an eye on. Shifting gears into our more regular economic data of the week, we got the July CPI and PPI numbers here this week. So we had the headline CPI come in at 3.2% in July, a slight uptick from last month, but still quite moderate from, the 9% inflation that we were at last year. We had core CPI at 4.7% increase from a year ago, which again is quite moderate from the near 7% peak of 2022. On a monthly basis, both headline and core CPI was just 0.2%, which surprised economists to the downside. We saw markets really encouraged by the data, with the S&P 500 popping up more than 1% Thursday morning on the news, but then retracting after that. What drove the July inflation report higher was largely shelter costs, which make up a huge chunk of the basket of goods that the CPI tracks along with, which you can see here, shelter costs up 7.7% over the last year, as well as transportation costs up 9% over the last year, and food away from home up 7.1% from a year ago. Pulling the July CPI lower was energy products that were down 12.5% from a year ago, as well as used vehicles down 5.6% from a year ago, and medical care services, which were down 1.5%. So this is really encouraging, and we are going to jump right into this PPI as well here. Along with the CPI for the month of July, we also got the Producer Price Index coming in just a little bit hotter than expected, where we had headline PPI up to 0.8%, which is still quite low. Less than 1% inflation from a year ago is quite good. And core PPI actually flat from a month ago at 2.7% in July. On a monthly basis, this was a headline PPI of 0.3% from June and a core PPI of 0.2% from June. And behind the PPI data, we had a few similar things to the CPI. So we had, just like CPI had a really high food away from home inflation rate compared to a year ago, we saw food cost up for producers 0.5% in just July alone in the 1 month, as well as higher trade cost up 0.7% month over month, and higher transportation and warehousing costs month over month as well. So I think between CPI and PPI, inflation is definitely trending in the right direction. However, we will continue to monitor these data points closely as they roll out. Final data point of the week, the University of Michigan's Consumer Sentiment Index demonstrated consumers' continued bullishness as the index remained relatively unchanged in August, but is demonstrating a strong upward move since late 2022. So you can see here in the 70s now where we are compared to the low, quite close to zero almost, in late 2022. So we're seeing consumers be a lot more bullish, and this was actually a 22% increase from sentiment 1 year ago in this index. So overall, we really enjoyed watching the markets this week, staying updated, and we hope that we were able to provide you a little bit of a valuable overview of what we were watching this week. So thank you so much, and we look forward to seeing you next week.